Ladies and gentlemen, good day and welcome to Puravankara Ltd Q4 FY'24 earnings conference call hosted by Axis Capital Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashutosh Mittal from Axis Capital. Thank you, and over to you, sir.
Thank you, Neha, and good evening, everyone. Welcome again to the post-result conference call of Puravankara Ltd. We have with us the senior management of the company, led by Abhishek Kapoor, Executive Director, Group CEO and CFO, Mr. Vishnu Murthy, Senior Vice President, Risk and Controls, and Neeraj Kumar Gautam, President Finance. I now hand over the call to the management for the initial comments. Thank you.
Thank you, Ashutosh. Good evening, ladies and gentlemen. Thank you for joining Puravankara Ltd earnings call. I am Neeraj Gautam, President of Finance at Puravankara Ltd. We appreciate your time today as we present our financial results and quarter year ending March 31st, 2024. Results and a comprehensive presentation are available on the stock exchanges for your review. In FY'24, Puravankara Ltd achieved exceptional performance, recording a pre-sales of rupees 5,914 crore, marking a remarkable 90% year-on-year growth. We anticipate continued upward momentum in pre-sales, driven by our strong pipeline of launches and the unwavering trust of our customers. Our commitment to excellence extends on all aspects of our operations beyond just financial metrics. For FY'24, Puravankara led with sales of INR 2,762 crore, followed by Provident at INR 2,041 crore and Purvaland at INR 1,122 crore. In Q4 FY'24, we achieved an impressive pre-sales figure of INR 1,947 crore, reflecting a 93% year-on-year growth. Collections were robust at rupees 1,094 crore for Q4 FY'24, representing a 66% year-on-year growth. For the entire FY'24, collection totaled rupees 3,609 crore, demonstrating a 60% year-on-year growth. Throughout this financial year, we launched 12 projects with total sellable area of 9.47 million square feet to meet the preferences of our diverse clientele across various categories. We have given total positions for 2,614 units in FY'24 across Puravankara Group. In line with our strategic plan and commitment to expansion, we are excited to enter the Mumbai redevelopment market. We have selected as the preferred developer for redeveloping a residential housing society in Pali Hill, Mumbai. The project has estimated development potential of 0.4 million square feet carpet area, and our share of sellable area in it is 0.21 million square feet, and a potential gross development value of over 2,100 crore. The strong response and numerous inquiries from the society indicate a continuous expansion of our development portfolio. In the previous quarter, we were appointed as developer for a redevelopment society in Lokhandwala, Mumbai, sellable area of 0.61 million square feet with a GDV over rupees 1,500 crore. Our launch pipeline is robust with approximately 14 million square feet of the new projects slated for the coming period. Notably, non-Bangalore projects now comprise 47% of our total launch pipeline. Additionally, Provident accounts for 42% of the launch pipeline, aligning with the market trends and our group's strategic focus. Coming to our debt management, our net debt increased from INR 1,741 crore in Q3 FY'24 to INR 2,151 crore in Q4 FY'24, and net debt to equity ratio from 0.85 to 1.14. I would like to update and highlight that where the debt increased debt, where we replied with increased debt. We have repaid IFC and ASK, two marquee investors who were with us and invested in two of our projects. And both the projects we have fully repaid them, and by utilizing this increased debt. Our cash and bank balance stood at 931 crore as on 31st March 2024, which indicates the strong liquidity profile ensuring stability and operational continuity. The strong collection figures highlighted our commitment to execution excellence. The success of our effective collection strategy is evident in our net operating surplus reached to INR 513 crores for FY 2024. To underscore our strong financial position, I would like to emphasize that as of March 31st, 2024, the balance receivable from sold units total approximately INR 4,457 crores. This amount covers approximately 50% of our remaining costs needed to complete the inventory currently available for sale. It indicates that substantial portion of the cost for completing the remaining inventory has already been secured for receivables, giving us a solid foundation to fulfill our financial obligations. Moreover, our cash flow visibility is equally promising with a projected amount of INR 7,455 crores expected over the next 3 to 4 years. In addition to this, estimated surplus from two commercial projects is INR 1,356 crores. Estimated surplus from launch pipeline project is INR 2,696 crores, totaling to overall estimated surplus of 11,507 crores. Finally, turning to our financial performance, in Q4 FY'24, our total revenue grew by 112% year-on-year to INR 947 crores. The EBITDA for Q4 FY'24 was INR 139 crores with a 15% EBITDA margin. However, there was a loss for the quarter of 7 crores. For FY'24, our total revenue increased by 60% to 2,260 crores. The EBITDA for FY'24 was 530 crores with an EBITDA margin of 24%. The PAT for the year was INR 52 crores. Our pre-sale value, I would like to highlight that our pre-sale value for FY'24 was 5,914 crores, and in sales and marketing expenses related to these sales numbers, and also the overhead incurred to achieve these sales numbers has been charged to the P&L for the financial year. However, the revenue in the P&L has come only for 2,614 units which we have handed over during the financial year, which has a revenue value of 2,260 crores. In conclusion, FY'24 has been significant and eventful period for our company, characterized by remarkable achievements across all key performance indicators. We are poised to expedite the development of new residency projects across India, delivering exceptional value to our customers and fostering long-term shareholders' value. Thank you for listening, and we welcome your questions you may have.
This is Abhishek here. Hello, everybody. Let me start with an apology for the delay and sorry for late upload of the financials. Going forward, I'm assuring everybody here on the call that we will keep this call the next day and give sufficient time for everybody to study the financials and be comfortable with asking questions. Again, apologies, and we are happy to answer any questions you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Himanshu Jain from Tiger Assets. Please go ahead. Mr. Himanshu, your line has been unmuted. Please go ahead with your question. Mr. Himanshu, your line has been unmuted. Please go ahead with your question. As there are no response for the current participant, our next question is from the line of Deepak Purswani from Swan Investment. Please go ahead.
Hi, good evening to the management team. Congratulations for the excellent set of numbers and also for the HDFC platform team. So my first question is regarding the HDFC Capital platform deal only. We have mentioned in the PPT there are some projects which are from the existing land bank to the extent GDV of 9,400 crores. And there would be some new acquisition which we are looking at 7,700 odd crores. So could you please share further details in terms of which are the projects which are being a part of this deal now? And also, since this deal will also incrementally monetize our cash projects at the faster pace, how should we look into debt going ahead? And whether this would be predominantly for the growth capital or there would be some part of the debt reduction from the incremental cash?
Thank you, Deepak, for your wishes. So Deepak, just to give you a background, so as you rightly mentioned, about 17,000 crores of which about 19,400 from existing. So what is happening is a part of the capital is getting deployed to unlock these lands where you have either some acquisition or some settlement or some sanction or something, some conversion cost, like that, to bring these projects to for the launch. Having said that, balance money that is available will get deployed in new projects, and that will create a further GDV of about 7,700 crores at a conservative basis. Second thing is that, with out of the way, clearly, property housing as a business is poised for growth, both in terms of bringing the existing land banks to the market, and to add more land banks, which is currently in the pipeline, where we are in advanced conversations in the marketplace. So overall basis, I think this will add tremendous value to Provident Housing. The second part I must mention is that from within the portfolio of existing projects, and this is 9,377 and 9,400 odd crores of GDP, itself will be able to repay the entire amount to HDFC. So entire new investment then becomes our free completely that you deploy. So in that sense, we already have a financial closure to repay the entire money that is getting invested by HDFC Capital. And if you look at existing projects, we are looking at about sellable area of 14 million square foot coming in from the existing projects, and we are looking at a surplus of about 1,200 plus crores coming, 2,600 plus crores coming from the existing projects.
Okay. And sir, secondly, on the Mumbai expansion plans, in the second half, we have added two projects, one in Lokhandwala and one in the Pali Hill. If you can throw some light in terms of the profitability angle of these projects, and also we have also mentioned there are certain few deals which are at the advanced stage of negotiation in the Nima region. If you can throw some light on that part as well, whether these would be continuously in the southern central market or this would be in the northern part of the market or in the western part of the Mumbai. If you can throw some light on that region, that part, that would be really helpful.
Right. So good question. One is, as far as both these projects are concerned, like we have always mentioned, our target, EBITDA target is in the range of 30%. For on average, whatever investments we are making, some may be little lesser, some may be little higher. But I must tell you that both these are marquee projects, and the scale and size of these projects in these locations is just not available. To have an excess of 2.5 acres in Bandra Pali Hill, I don't think that we have many plots or any plot which is of that size. So that obviously clearly commands a premium in that market, and we are already, receiving calls for purchasing there, right? So we're very, very optimistic about what kind of realization we can make at Pali Hill. And of course, in Lokhandwala again, this is absolutely a prime Lokhandwala plot, and there is significant demand in that market. It's a very mature market, and we believe that we will be able to bring in the kind of quality that Puravankara brings in, we'll be able to command a premium in that market. So again, as I mentioned, we will target as per our company policy the 30% EBITDA. That is one. So as the planning is concerned, as a business, when we look at a city in various geographies, for us, what we intend to do is we intend to have presence in western suburbs and South Mumbai and central suburbs in terms of redevelopment. So if I was to break this down, redevelopment strategy will spread right from, like Dadar Mahim, going up to western suburbs up to Borivali, and on the southern side in the island city, and on the central side up to Chembur. Beyond Chembur redevelopment opportunities, we may be very, very mindful and careful. We may not evaluate because of the feasibility of the redevelopment opportunities. That is one. As far as development JDAs or acquisitions are concerned, we are looking at across the board, across the city. Clearly, we want to enter. We already have a project in Dombivli, Shilpata. We are intending to add a project in Thane because Thane is a big market, and we believe that we want to be active participant in that market and bring in and get a piece of that market as well. So Mumbai as a strategy, I think we are very clear that we are looking at presence in all of these markets. Of course, we are also evaluating the new airport area and opportunities thereof, because we believe that at some point in time that market will open up.
And sir, just continuing on that part, what is the investment we have made in the Mumbai region so far in terms of the project acquisition, and what would be the investment we would be looking out to do incrementally? And what would be the launch pipeline for this Bandra project as well as for the other projects, Lokhandwala project?
So our target would be that Lokhandwala we should definitely take it to market, and Lokhandwala we have said Q3, between Q3 and Q4 for sure. And Pali Hill, our target will be that we should take it to market in Q4 or Q1 of next year. And as far as investment is concerned, I think we can send that data to you separately.
Sure. I have few more questions. I will come in with you. Okay.
Thank you.
Thank you.
Thank you. The next question is from the line of Sumit Kumar from JM Financial Institutional Securities. Please go ahead.
Hi, good evening, Abhishek. Thanks for taking my question, and congratulations on a great set of numbers as well as...
Sorry to interrupt you, sir. May I request you to use the handset, please?
Is this better now?
Yes, sir.
Yeah. So, thanks for taking my question, and congratulations on a great set of numbers and also on conclusion of 2 marquee deals in the Mumbai market. My first question is on the land bank that the company has, which is sizable, close to around 28 million square feet of, development potential. So in terms of BD, business development, how are you looking at it? What is your target, at least on an indicative basis for the next 2-3 years? And as a follow-up to that, how much of the launches would come from the existing land bank monetization, and how much would be from the newer projects added?
So, for the next year, as we have published, we are looking at launching about 14 million square foot from within the current land bank. As you know that we have, we've sold out about 7.35 million square foot last year. So the velocity at which we are selling, we need to replace our inventory. So our target will be to maintain our 40 plus million square foot of inventory at any point in time. So therefore, there is a big gap in terms of acquisition now, given that we are launching so much, as well as we have sold, the kind of sales that we have already done. So therefore, our goal will be to minimum maintain 40 million square foot, but at any point in time, our target is that from the date of deployment, we take the product to market within 9 to 12 months outer limits, right? So that we're not sitting on any investment. It's just a matter of plan sanction and launching the project at any point in time. So in that sense, and that's point number 1. Point number 2, in terms of I think you asked about geography, isn't it?
No. What will be coming from the existing land bank of 28, and how much do you intend to add?
So 14 million square foot will come from current land bank, and whatever we add this year. So as I think somewhere we have mentioned in the ICP that we have already paid 300 crores of land advances, and we are expecting closure of some of these projects in next, say, you can assume within next 1 quarter, say 90 days time frame. And as those get closed, our endeavor will be as much as possible we can bring some of these projects into the market within the same financial year. So we're not able to give a guidance right now on what we'll be able to bring to the market. Obviously, there's an internal target, and there is a bunch of stuff that is going on. But our goal will be to definitely bring in more inventory to the market so that we can continue to grow at a rapid pace, and we are able to beat the market growth rate. So to answer your question, 14 million secured, and it will be definitely above 14 million what we take to market this year.
Sure. And in Mumbai, is it that you're only looking at redevelopment, or in the newer markets like Thane and near the airport area, new airport area, you'll be looking at outright land acquisitions as well?
We are looking at outright as well, JDA as well, both in Thane and Navi Mumbai, as in Panvel area, because we see that also as a growth vector over time. But we are looking at both options.
Okay. So that's helpful. That's all from my side. Thank you and all the best.
Thank you for your wishes. Thank you.
Thank you. The next question is from the line of Shivang Joshi from Centrum PMS. Please go ahead.
Good evening, sir. Thank you for the opportunity. Firstly, I want to understand, when I look at the presentation on your debt slides, so your net debt has slightly gone up, and consequently your NCD, OCD amount have gone down. Can you throw some light on this? And consequently your borrowing cost, as highlighted in your cash flows, net interest cost has gone up from an average of 70-80 crores to 200 crores. If you can answer in this part.
So you are absolutely right. Two of the NCD amounts which we have been reporting as NCD issued to the IFC and NCD issued to ASK hasn't come down, because we have fully repaid to them, and as in our slide number 14 we have given the detail, about 410 crore we have repaid to them, and these are repaid from the project which already launched. We have raised the money at a very competitive cost, and from there this both investment has been repaid. So that is the reason of these two NCDs going out of our debt slide, and now however, while we repaid, and to that extent our debt has gone up. So for the quarter, if you compare with the immediate previous quarter, debt has gone up by 519 crore. The end use also we have given in slide 14. About 410 crore is gone towards giving interest to our repayment of IFC and ASK. And we also invested about more than 300 crore in the acquiring new land parcels, which Mr. Abhishek just mentioned, enhances. So part of the money, part of this loan has gone towards funding those advances, and part of the money has been used from internal accruals. So I hope I given the answer of all your questions. Or if you have anything more, I can.
Okay. So lastly, you refinanced your NCDs through your interest-bearing debt.
But those NCDs were equity in nature, and thereby there is a certain amount of IRR it could have gone from the project cash flows. However, paying them back then is actually in essentially reducing the implicit cost of capital. Today, the borrowings are at the bank rates, and thereby the overall cost, which is otherwise would have company having, which is not going to increase.
So it's added to the bottom line.
And added to the bottom line.
Okay, so your increased payout of interest of 200 crores is essentially of that nature. And hence you see a higher interest.
Optically, yes. However, the return which otherwise I would have given to IFC or ASK, that will not go. That would have been much more than the interest which I otherwise am going to pay to the bank.
Got it. Because for the first time we saw your interest payout higher than
what Neeraj is saying, Abhishek here.
Yes, Abhishek.
We have great tailwinds and great volumes and velocity that is happening right now, right? So we want to take advantage of the cash flow coming in and making sure that we are able to bring as much value to the bottom line and to the value creation for the shareholders as possible. And therefore, it makes so much sense to say that, why don't you, reduce your cost of capital and take it to the bottom line and pay this off. So that's the basic thesis. I mean, the demand has been fantastic in these projects. The cash flows have been fantastic, and you're saying, why not? In fact, the money taken for ASK, I think, should be over before December. Will get recovered because everything is sold out over there pretty much. I mean, it's selling pretty fast, and the construction is happening. We'll complete the project. Similarly, we'll have the other projects which IFC had invested in. We are expecting the surpluses coming in there and starting to repay pretty quickly on the money that's been drawn down, and then the cost is lower. So in the business sense, it makes fantastic sense.
Okay, great. Second, when on your launch pipeline, when you say 14 million square feet, 7 million is the phases that you would be opening, and this would be from your land bank. So optically, should we expect, I mean, last year you closed at how much? 9 million square feet of launches?
Yeah, we opened 9 million square foot of inventory for sale last year. Out of 13 odd million that we got for sanction, or 10 million square foot, we opened about 9 million square foot. You're right.
And this year, what you have mentioned in your slide 22, launch pipeline 7.28 million square feet. What is the status of approvals of these projects? Are these already at advanced stage of approvals? And should we see large part of or all of them coming in this year itself? Something if you can highlight that.
Absolutely. So I think a lot of momentum you will see starting from the end of second quarter, and possibly a lot of it will come in the third and fourth quarter because they are all in approval stage. And as I mentioned earlier, our target will be to make sure that we make sure that we open higher than what we have opened in the last year. So while we have opened 9 million, we'd like to beat that, but this is what we have done here is give you visibility of what we already have in hand, which we have complete clarity on that this is definitely coming. Having said that, I think that we will possibly, in all likelihood, add some more projects to it in next 2 quarters.
Okay. Finally, on your cash flows, when I look at the closing cash and cash balance is 931 crores, could you give a broad split between how much would be in escrow which you cannot transfer to the other, which has to be retained at a project level, and how much would be free cash?
About 500 crore money is lying into different project escrow accounts, RERA accounts, etc., subject to submitting of certificate, withdrawal, etc. And about 400 crore are the fixed deposits, money which we have raised or taken some loans and then money yet to be deployed. So money for land purpose. That is money lying in the form of fixed deposit with the banks.
If I may continue, a follow-up question on that. On the deployment fees, the Mumbai 2 redevelopment project.
I request you to come back for a follow-up question.
I'll join back. Thank you.
Thank you. The next question is from the line of Abhishek from Yes Securities. Please go ahead.
Good evening, sir. My only question is that just want to understand the structure of SDFC platform. So how, what are the responsibilities, how equity would be infused? 1150 crores of total platform. So what could be our share in that, and how cash flow would be distributed?
First and foremost, I would like to update you. It is the SDFC NCDs are zero coupon NCD, zero coupon bond. So there is no interest servicing for those NCDs. And this money they'll be investing, NCDs will be issued by the Provident Housing Limited, 100% owned subsidiary of Puravankara Ltd, or subsidiary of Provident Housing Limited. In the first tranche, Provident Housing Limited will be issuing NCDs of 550 crore. And those NCDs will be zero coupon bond. That is the structure. And the money will be utilized out of the entire facility of 1150 crore. We will be, investing about 350 odd crore in existing projects. And remaining money will be going toward acquiring new land parcels. And the service will happen to this NCD by sharing certain percentage of cash flow, so cash flow surplus from the projects, and there will be no fixed obligation.
Understood, sir. And sir, another part is when we are adding up when we are transferring our projects, right, which already we have. So are we going to get something out of that, or that is a part of structure only? I mean,
we are not transferring any of our assets. Those assets are there where they are. In the Puravankara Ltd, the assets are there, and Provident House Limited assets are there. The money which we are utilizing towards unlocking those assets, either land parcel or existing projects, and the surplus of these projects will go towards servicing the NCD. Our plan is that service or fully repay this NCD from the existing project itself, and new project which is going to require from the investment will be additional assets for the company.
So grossly, what kind of cash flow or the percentage of cash flow will be diverted to us in general?
No, the cash flow will not be, there is no fixed cash flow which will be diverted to them. If these projects which are part of the platform, there will be escrow mechanism, and basis the business plan, if there is any surplus left in the month, then out of that surplus, certain percentage will go towards servicing of the NCD. In a manner that NCD is beside full repayment of NCD, also NCD gets the agreed return.
So if you look at it, Abhishek, I'll just add to this. So total from within the existing projects where the capital is getting deployed, which Neeraj was talking about, we are looking at about 2,600 plus crores of surplus. Now that 2,600 plus crores of surplus will be more than sufficient, not just to repay HDFC, give their return, but leave surplus for us. Other than that, what this will do is it will add further. We are estimating about 1,900 plus crores of surplus for us from the new investments. So with this, our ability to scale Provident Housing and almost develop 21 million square foot, which is what we are targeting from this platform, will be possible, and adding significant value to the business and the organization.
Okay, sir. Got it, sir. Thank you. That's all from my end.
Thank you. The next question is from the line of Ranodip Singh from MAS Capital. Please go ahead.
Thank you for the opportunity, and congratulations on the great set of numbers for FY'24. My question is at a strategy level, like how we have a sub-brand Provident under Puravankara, is there a school of thought for having another sub-brand in the...
Sorry to interrupt you, sir. May I request you to use the handset, please?
Am I audible now?
Yes, sir.
Yeah, my question was on the strategy level, like how we have a sub-brand in the affordable housing space, which is Provident. Is there a school of thought of having an ultra-luxury brand, given the premiumization theme in India is picking up loud and clear, and we've seen success stories of some of the listed players, some of the great projects that they've launched, and it's sold like in record days. So is there thought on those lines?
See, as a strategy, I'm sure you're aware that Puravankara is clearly the luxury brand, and from the way we present or we will present the product as far as ultra luxury is concerned, will obviously a much higher, many notches higher, and therefore the whole approach and model that we are looking at is different. But to answer the question, will we look at a new brand? We don't need to look at a new brand, because Puravankara itself is known for luxury homes. So, and the kind of quality and the product that we bring on the table, I'll give you an example. For example, all of these redevelopment projects that we have won, and bunch of them which is currently we are closely engaging with, all of these customers are already living in these ultra luxury homes, right? And of course, the project has been developed long back, and they may go into redevelopment. But having said that, they all come from very wealthy positions, and they have visited our projects, and they said, we think your quality and your brand is fantastic and is brilliant. So we don't need another brand. I think brand over the last 50 years has has gained so much respect in the marketplace. I mean, if you go out there, and we see this every day, especially in the Mumbai and Pune market, which is relatively, people say it's a new market, but then every time I'm out there talking to people and the team is out there, we realize that, the brand has got phenomenal recognition in that market. So, we don't need another brand as a strategy. What we will do clearly is take the product several notches up and be extremely competitive in the kind of product we bring in the market.
Sure. A connected question on similar lines. Our average realization seems to have kind of stabilized very nicely around that 7,900 mark. With our foray into Mumbai and with the luxury brand that you spoke about, do you see it clocking the 10K mark in the next coming year?
Look, definitely, see, if you just look at Puravankara in isolation, without Purva Land and Provident, our average realization is already above 10,000 rupees a square foot, 10,229. Provident Housing is at 7,800 and Purva Land is at 5,444. Now, see, what's happening is, now, if you look at Purva Land, like last quarter, we had launched a project in Chennai where our average realization was, say, 3,000 rupees a square foot. That drags down the overall average realization. But are we making money at 3,000 rupees? Of course, we are making money on 3,000 rupees, right? But your average looks smaller. But if you break this down and say, we've already crossed 10,000 in Puravankara, and I can tell you for sure that which we are already in Bombay, we will definitely, average realizations will go up, and Puravankara average realization will relatively go up much higher. That's clearly going to happen.
Sure. And my last question, I think great set of numbers in terms of the sales value, not almost touching 6,000 crores. And I understand as per Ind AS, the realizations will happen at the time of delivery. So tentatively, can you give me a sense, when do we see the peak EPS that we've seen in 2012, 2014 levels of around 6.5 rupees? When do we see that coming back?
Yeah, I think this journey is between next 3 to 4 years time frame. But you will start seeing green shoots possibly in the early third year from now. So I would say this is 24, 25, 25, 26. So 27, 28, you will start seeing the green shoots. Because see, the thing is that you are expanding so rapidly, and these sales have happened in the past, which you are delivering now, and that is causing, as per the accounting standard, what you slightly said, the way it is looking on paper. But as you start to deliver more and more projects and newer projects, and the pace of delivery starts catching up with the pace of sales. Closer, it will never catch up, obviously, because you will continue to grow, but it starts becoming better and better. You will see better and better gross profits, and some of these older investments will start making capital. Like, for example, a large amount of G&A may have been spent in the western region, but you've added, or you will continue to add significant top and bottom line to the business in next 9 to 12 months time frame. So I think I would say the answer is, I would say third year and fourth year would be significant. You'll start seeing green shoots possibly in 24 to 28 months.
Sure. Appreciate all the responses and wishing you all the best for the next year. Thank you.
Thank you.
Thank you. The next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Hi. Thank you for the opportunity. So my first question is regarding the...
Sorry to interrupt you, sir. I request you to use the handset, please.
Hi, am I audible now?
Yes, sir.
Hi. So my question is with regard to the launches for FY'25 that we have mentioned around 14 to 15 MSF. Could you please also mention what's the value of the launches that we are going to do?
So we are looking at a total top line, estimated top line is about 7,443 crore pre-sales value. And you're looking at a surplus from these projects of about 2,696 crores.
Okay. And we have delivered around 2,600 units for FY'24 as per our PPT. How many units do we target to deliver in FY'25 and 26?
Look, I mean, last quarter itself, we delivered about 1,188 units, and we have received OC for total of which is pending to be recognized is about 1,700 units, right? Out of 3,600 units for which we have already received OC, we have handed over 1,700. We will be handing over at least 1,700 from the OC, which is already received. Our target for the year is about 4,000, approximately between 3,500 to 4,000 units, because what may also happen is, as it happened last year, is when you get the OC to the time your customer is able to take possession, sometimes there is a journey. But our target will be to deliver, like we delivered last year, about 2,200 plus units, 2,600 plus units. In the next year, our target will be to deliver anywhere between 3,500 to 4,000 units.
Okay. And would it be fair to say that likewise our reported basis, our revenue growth would also be upwards of 50% for FY'24?
I mean, if you do the math, clearly from 2,600 units, if you go up to 4,000 units, obviously you will see you can map the growth. As far as the revenue recognition is concerned, we'll have to just see the mix of inventory, whether it will be exactly proportionate to that. Because obviously there will be certain amount of land and certain amount of plot development which also will get delivered. So we'll have to just look at the realization and come back to you with a specific answer. But having said that, I think, we can expect that revenue growth will be intact.
Okay. And lastly, on a reported basis, again, then what would be our sustainable EBITDA margins?
Look, EBITDA margin, as I mentioned earlier, is also factoring into my marketing cost and my G&A for expansion. I will leave that disclaimer on the table because a business that is growing very rapidly will have to make investments ahead of getting the return on the investment in terms of GDP and surpluses. That's as far as G&A is concerned. As far as marketing is concerned, clearly we are extremely aggressive in the marketplace, and with the quantum of pre-sales that we will look at, as it goes up, we'll definitely look at increasing costs, which will clearly get booked as expenses. So to that extent, leaving that disclaimer, I would think that our target is pretty much intact. If I look at the project level EBITDA margins, they're absolutely intact. But what's happening at the corporate level is that when you put that gross margin and then you put in your marketing costs of new launches and of increased sales, and you look at your G&A, and that's where it starts to look different. So that is what earlier conversation was as to when do you see the books reflecting really the kind of value we are creating in the organization, and I think the brand will start seeing that reflecting on paper, I would say in the third and fourth year, quite stably, and then possibly grow pretty rapidly.
Okay. No problem. Thank you.
Thank you.
Thank you. The next question is from the line of Sushil Jaiswal from Bajaj Capital. Please go ahead.
Yeah, good evening, sir. Based on the existing growing sales and good collection, what is your going forward trajectory? Do you think that it will sustain the same in the next couple of quarters too?
If you're asking about the overall real estate market, yes, we believe that it will sustain. The market is good, demand is well there, and it will sustain.
I think what may happen is that we have pulled a lot of launches in the last quarter, in the last year. We may see some of our launches spill over to the second, third, and the fourth quarter. We will see a lot more pre-sales, I would think, in the second, third, and fourth quarter. A lot of it will happen in the third and fourth quarter specifically. So in the first two quarters, I think we have plan sanctions we are awaiting for. They're all in advanced stages, but elections are around the corner. Elections are ongoing across the country. Then there are some state elections happening. So keeping those in mind, you may see some of these launches come in the third and fourth quarter. So keeping that disclaimer in mind, I think everything else is on track. I would see a lot more pre-sales number in the third and the fourth quarter.
Okay. And my second question is, so as a real estate sector has begun to rise, so do you think this scenario is in every part of the country or just some specific parts? Also, a majority of the business comes from southern part and some from western side also. So do you have any plans to expand your presence in northern side like Delhi NCR region also?
So look, we are seeing demand across the country, and we've seen tailwinds and consolidation across the country, across the segment, which is great advantage for a brand like Puravankara. To answer the second question, yes, we are looking at NCR. We are evaluating opportunities. We have already started to put a team on ground, and we will definitely look at. Our intent is clear that we will be a national player and we will rapidly expand in new geographies. West is obviously something which is maturing, which we are already seeing, and we intend to first, while we do the acquisitions and look at new acquisitions in NCR, Gurgaon and Delhi to start with, our first endeavor will be to make sure that we get our launches in the Western region. So this year, I think this financial year, Western region will be a big one for us.
Okay, thank you, sir. That's all.
Thank you. The next question is from the line of Shivang Joshi from Centrum PMS. Please go ahead.
Thank you for the follow-up, sir. I wanted to understand what is your take on the amount to be spent on BD in FY'25 and 26, considering that you have got decent free cash and good collection run rate? And on the two Mumbai projects, what is the capital that you would be deploying? So, and if you can quantify this as both local and foreign.
So as far as BD is concerned, as I mentioned earlier, we are not looking at a capital target, but we are looking at a replacement target. In the sense that we have already launched and sold last year about 7.35 million square foot. And this year we are looking at launching another 14 million square foot. So clearly we are looking at replacing that inventory and staying about 40 million square foot at any point in time. And the second thing that you asked about West, our total cost to launch for these projects is in about 900 crores. And as I mentioned earlier, we are looking at, that will be about 650 crores. Cost to land cost plus cost to launch will be about 650 crores for these two projects specifically which you asked about. As we mentioned earlier, between these two projects we will be able to generate more than 3,600 crores.
Okay. Any specific numbers you have in mind or as a strategy, what amount you will be putting as a capital for the West? Since your land banking, you will have to start afresh in the Western region. Afresh in the sense, relatively, you have a higher land bank in the South versus the West.
Look, as I mentioned, so, one of the things which I mentioned in the previous calls is that a market like Kochi, we are sitting with a significant surplus of about 1,800 crores. What we are really looking at doing, and hence you will see some amount of capital churn and debt churn and, is that we're looking at reallocating this capital into the Western region, which is Mumbai and Pune, right? And that is significant capital. I mean, even if I discount it and say that, I will take out certain amount of capital from this region and reallocate that capital in the Western region, clearly, the number I mentioned is there, right? So I think we have enough and more within our portfolio to look at in terms of equity to be able to deploy in the Western region. And as I mentioned, Mumbai in the past also, Mumbai is going to be a significant part of our portfolio. I've been saying this for a long time. We intend to get that to at least 40 to 50% of our value-wise business. Square footage will be lesser, but value-wise, we'll definitely look at getting at least 40 to 50% of our pre-sales from the Mumbai region. So we'll continue to deploy in that market.
Okay. Great. Thank you. Thank you for answering the question, and congratulations once again on the very good set of numbers.
Thank you. Thank you.
Thank you. The next question is from the line of Saurabh Gilda from Motilal Oswal Financial Services. Please go ahead.
Yep. Hi, am I audible?
Yes.
Yes.
Hi. So congrats on the good set of numbers, and most of my questions are answered. I just have one question on your, trajectory for pre-sales going ahead. I know you don't give a exact guidance, but just wanted to understand what sort of pre-sales that you want to achieve, or what sort of growth that you intend to achieve for at least for the next 2-3 years.
Look, I think I've mentioned this in the past. As we don't give guidance, you're already seeing what we give guidance on is the number of projects and square footage we're going to bring to the market, and I've also indicated that we'll definitely try and bring in more than what we brought in the last year. Having said that, our goal is definitely to beat last year's number and to beat the average market growth rate. So if we are assuming that somewhere in the mid-teens will be the market, we will definitely beat that growth rate in terms of our pre-sales numbers. And our plan is, to ensure that we are able to achieve that number. We have, look, to answer it in another format, we are definitely part of the consolidation in the sense that we are going to make sure that we gain a lot more market share in the process of this consolidation. What will be that extent of market share? I think that remains to be seen. It's also a factor of how much supply we are able to bring into the market, which we are working on an ongoing basis. So, we'll see where we land at the end of the year, but obviously we're not looking at just growing at a market rate.
Okay, fair enough. Thank you.
Thank you.
Thank you. The next follow-up question is from the line of Deepak Purswani from Swan Investment. Please go ahead.
Thank you, sir. Thank you for the follow-up opportunity. So, firstly, on the launch pipeline, on the launches front, how much was the sales contribution from the new launch projects in FY'24?
In FY'24 from new launches, let me come back to you with the exact data. I can share with you. We'll try and see if we can give it while you ask your next question. I'm sure you'll have more.
Sure.
Otherwise, we'll come back to you at a later date. You can write to us and we'll respond to it for sure.
Sure. And so just harping again on the interest expenses, if I were to look from the cash flow statement point of view, our interest outgo was 443 crores against a net debt of 2150. Just wanted to understand when we say repayment of the NCD of ASK and other investors, was there any premium component which was payment was made for that during this quarter? And if yes, then what would be the sustainable kind of interest expense outflow which we would be looking out at the current juncture?
So these NCDs have been paid at an agreed IRR. There's no additional premium. However, whatever IRR was agreed with the investment, or that IRR it has been paid. And the second answer to your second question, so while repaying these NCDs of IST and ASK, we have taken the debt at competitive rate. So to that extent, interest will go up by servicing those debts. However, the beginning of the conversation, Mr. Abhishek mentioned about it. These both the debts for ASK as well as the IST investment which we have repayment which we have given from the existing project, which project is doing very good, and we are estimating that from the project cash flow itself. So the SI and repayment mechanism, substantial amount of debt will be repaid in this financial year itself.
Plus, there are surplus from the next phase of the project. Right. Significant surplus in that project. I mean, significant surplus in the project which Neeraj is talking about.
Okay. But from the cash flow perspective, I mean, from the next year perspective, what would be the interest outflow we would be looking at?
See, look, it's our kind of gross debt is about 3,000 crores. 3,000 crore and at our 11.5% is about 11.5% as our average cost of debt.
Okay. So roughly 450 odd crore, 350 or 360 odd crore.
40 odd crore.
As long as we are not adding more debt to
also.
Yeah, correct.
So that's
The repayment is also there. About 900 crores the next 12 months? What is the repayment amount?
900. I just part of it will be through some
900 crores. SCBs and that's right.
Hope that answers your question.
Yeah. Okay. Yeah, that's it from my end. Thank you.
Thank you.
Thank you. The next follow-up question is from the line of Abhishek from Yes Securities. Please go ahead.
Thank you for the follow-up. Sir, just one question. We have invested roughly upwards of 750 crores towards land in last 2 quarters. So basically, we are taking care of BD. So how much more capital are we allocating towards BD, or how we are going to how much of BD we are targeting to maintain the growth which we have seen in last 1-2 years? So that is one. And secondly, with that growth, how we are going to maintain the balance between growth and debt?
So let me break this down for you in 2 parts. One is, as I mentioned earlier, our growth, we are always going to work towards outperforming the market and gain market share, right? And we are expanding in new geographies to ensure that our portfolio is diversified, wider and deeper. Now, having said that, as I mentioned earlier, we want to first get to make sure that whatever was our original land bank, which is to extend to about 40 million square foot, is secured back in our book. We want to maintain at least that much land bank at any point in time. And the target is that we are able to move efficiently to scale launches and do the launches within 9 to 12 months. So, because we don't want to sit on any assets, we don't want to buy and wait, we will buy and deploy and launch. So between these 2 things, the fact is that we have about 11,500 crores of surplus within the accruals, within the business, internal accruals at this point in time from the projects which are already launched and from the projects which we launched in the current financial year. Over next, you can assume, say, 4 years time frame. Now, as that capital comes in, and we are reallocating capital, so we can't necessarily wait for that capital to come in. We will, say, for example, Kochi, I mentioned a little earlier on the same call, we have got significant surplus. I would estimate it would be about 1,800 crores of surplus sitting in Kochi, and for no reason, including land and profits. So what we want to do is take that, and obviously that means that to bridge that, you may draw some money against that, and take some cash out from there and put that money in Mumbai, because you believe that you'll be able to create a lot more value and you'll be able to do a lot more in Mumbai. So in that sense, first priority will be to create growth from rebalancing and reallocating capital within regions. That is priority number 1. Priority number 2 for us is to look at opportunities where we can raise equity. So, for example, we are working towards now, we are evaluating the next AIF. The first AIF is almost deployed. The money is starting to, I'm sure the next quarter will start to return because the project is being launched, right? So, look at AIF as an opportunity. Third, you will go and create another platform where, like in HDFC case, you've created a platform, you'll create another platform where you will look at deploying capital. Other than, for example, the first priority, I said, is you take money out of a region and put in a new region. So this will be a constant churn of capital to create growth opportunities and ensure that your BD is robust and you are able to plan not for this year but for the next year and the year after. Because whatever we do this year will have an impact on the next year and then the next year, right? So that's how we are looking at the business. And goal, as I mentioned earlier also, that we are very, very comfortable with, debt numbers on a per square foot basis being under about 1,000 rupees a square foot. So, we'll keep these parameters in mind. And the other factor that you must watch out for is our operating surplus. Now, last year, if you see, our operating surplus was net operating surplus was more than 500 crores, 513 crores. Obviously, like Neeraj mentioned earlier, you have paid out about 300 crores of land advances, right? So the target will be to stay focused on cash flows, which is collections, continue to spend money on your operations, run your operations aggressively and efficiently. And with that, you will create. So, for example, if you look at total operating, not net operating, but operating surplus was 298 crores. So, what I'm trying to say here is that between internal accruals, reallocation of capital, AIF, equity platform, you will be able to manage the entire BD that you are working towards.
Capital requirement for the BD.
Correct.
And so to just get to it, in the first question when you asked about the HDFC structure, there are 750 crores is committed for BD only. This part of structure itself.
Okay, sir. Understood.
I definitely asked about that question about HDFC.
Yeah, sir. Right. Thanks. That's all from my side, and best of luck.
Thank you.
Thank you. Ladies and gentlemen, we'll take this as a last question. I would now like to hand the conference over to the management for closing comments.
Thank you, ladies and gentlemen, for joining our call. I hope we have been able to answer all your questions. Me and my colleagues are available. If you have any further questions, you write to us and we'll answer your questions. Thank you.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.